This is the Illinois Economic Summit, the 2021 version. I'm University of Illinois Extension's Todd Gleason. Today, we'll explore farmland markets and the factors affecting values and rental rates. Again, this is part of the FarmDoc Daily team, and Bruce Sherrick is here. He's the director of the TIAA Center for Farmland Research. Thank you, Bruce, for being with us. I know you've got a great deal to get through today. And you're going to start off, I think, with a poll. Of course, you've been studying farmland and the macroeconomics for a career. We appreciate you taking the time, and the floor is now yours.
Thanks, Todd. And as you said, we will start right off with a poll. Going to make this really easy on myself and get the answers from the audience today. So we want to start just with the area you live in. A real simple poll question. Have the farmland values, again, around where you live, increased by more than 15%? Increased by 10 to 15%, increased by 0 to 10%, stayed about the same, or decreased in value compared to a year ago. We'll kind of watch this for a few seconds. Looks like we are in progress.
I will take a moment while they're filling that out, Bruce, to remind them that they can put questions in the question box over on the left-hand side of the page as people continue to come on here for this Farmland Values webinar with Bruce Sherrick. And if you've got questions for Bruce beyond what this poll has to say, go ahead and put those in the box. I think, Bruce, as we're coming along here, we've got enough to close that poll out. You can take care of that and tell us whether you think those answers looked about right to you.
Okay, looks like 40% indicate they've increased by more than 15%. 36 increased by 10 to 15%. So 75, 78% think that values have gone up by at least 10%. 20%, 23% increased by 0 to 10. 1% stayed about the same, and 0 people have indicated that farmland values have decreased compared to a year ago. That's very consistent with what we understand as well. And again, I'll point to some pretty common resources. The Fed Reserve Ag Letter, Dave Oppedahl does a great job up in Chicago, getting those up and running. And we have sections through the middle of Iowa that look like they're up maybe 25, 30% year over year. We have the USDA number. We have our own survey of Illinois society. We track the auction results and to some degree private treaty results as well. Especially Illinois, Indiana, and Iowa. They're the easiest places for us to watch. But yeah, that's been a remarkable year to say the least. Today, all we want to do, it's a very broad assignment. We want to look at the farm level factors that drive farmland values and rental rates and examine the connection between some of the macro events in the last couple of years. We just all have to admit have been really quite bizarre, really quite remarkable. We'll try to connect some of those macro market events and understand which ones are, in a sense, real and expected, and which ones might be more or less related to the things we hope we don't continue to repeat every couple of years. And then kind of in the process, develop a framework to anticipate what would happen going forward if commodity prices go down or go back up, or if interest rates go up further, or if inflation surprises us and gets larger than we expect, or smaller than we expect. So we'll use today the next hour or so to kind of go through those issues. We'll remind you that, as Todd indicated, these are always archived after the fact, and the prior webinars from our IFAS series this year are also archived. Gary Schnitke provided a great deal of really good information about farm level income and rental rates in the December 1 webinar. So part of the task today has already been accomplished in a prior webinar. So to kind of set the stage, some things to kind of level set. Of course, in the last 2 years, 2.5 years, we've had this massive amount of fiscal stimulus, massive amount of disruption to the supply channels, massive realignment of interest rate markets, not just in the US, but around the world through central bank intervention. And this has happened at what would have to be considered an unprecedented scale. We've just never seen it before. One of the questions, of course, is how long can this go on? Can we keep spending money at the rate we're spending to try to hold the economy over while we're getting back into something where regular production can take place. And I want to point out that I'm going to talk a lot about the difference between spending and production. Not tongue-in-cheek at all, but I describe this as the difference between the toilet paper effect and the eating out effect. If you buy a bunch of toilet paper in advance, you probably don't change the total amount of toilet paper you use, you change when you bought it. If you skip eating a meal out and instead eat it at home, you're probably not going to go back out and eat a whole bunch more meals later outside of your home. So there's a really important difference between the things that involve losses of production and things that involve spending differences where we may have had government or other stimulus spending that at least made up the difference. Number two, we have had, you can't open a newspaper, read a headline. You can't listen to the financial news without hearing a debate between Treasury and the Fed and the rest of the economists in the world. I had, just as a fun little joke to start, I had a friend send me a meme a few days ago about the Fed decided to fund a $2 trillion study to see if they could figure out why spending $8 trillion would lead to inflation. But anyhow, the evidence around inflation is definitely increasing and getting a little more solid. This year, the ag input prices, especially things that are energy dependent like fertilizer, have really skyrocketed. Again, great IFAS webinars if you've been following us along for the last couple of weeks. Some great cost of production information in the prior one. Energy, of course, kind of spiked up, but we still don't know how much of this is a result of stopping the economy, creating interruptions in supply channels, and then having the need for something chase its price up. And if we were to get back to a more normal environment, whether those would return. So this is a question about whether the Fed and the rest of the world, ROW, is able to manage growth as we return to a post-pandemic world, if we return to a post-pandemic world. I used to always say when, I'm now starting to say if as well. A third bullet point, ex-US drivers for US asset values. It's become very clear that the demand for food outside the US, and as incomes increase in other parts of the world, the demand for higher quality proteins in particular increases. So the long-term thesis for demand growth in food has in fact been borne out and is being borne out. You often hear people refer to the FAO reports and the 9 billion people that will inhabit the planet. I find that when I start presentations with that, I end up sort of dividing the room in half because there are people who have different views. So instead I say, do you think there will be more or less people in the world in the future? Answer that in your own mind. And do you think they'll eat food? And if so, what do you think will determine what they eat? And I think that has to be settled in order to get to an understanding for future drivers for commodities in particular. And again, the U.S. competes with the rest of the world for production of commodities as well. So we'll have to look at that in the context of exchange rates and interest rates and so on. A fourth one, I think it's hard to overstate this, although I don't quite know what the story is that I'm stating. It seems that we're changing our policy targets and priorities around eco-services and the role of agriculture in the climate debate. I hope I don't sound a little bit superficial, but I'll point out that I think headlines are often confused. People think the word carbon equals climate and think the word climate equals something and make immediate connections to questions like U.S. agriculture or animal agriculture that may be, I believe the reality is much more complicated. And the counterfactuals are not well defined. So if we don't produce as much dairy, what do we produce instead? Or if we capture methane from the source, what do we not do somewhere else? In any case, it does seem clear to me that we have developed an expectation that we're going to include climate-based impacts in the pricing and demand for most services downstream. If that's true, and if you do the math carefully, the only industry that has enough commas, and the only place you can actually sequester enough carbon includes the original solar collector, which is a plant, and leaving some of the plant matter in the ground for a while. So agriculture has become part of the solution rather than only part of the problem. And I think the development of this area and the number of companies looking to own a channel in the carbon payment stream is something we really do have to pay attention to. We really just can't ignore that going forward. And the last one, finally, low interest rates have been maintained for a long time. I have my normal term structure graph coming up in a few slides. And this question is, when you're buying future income and interest rates are low, you'll pay a lot for that future income. That's the income multiple effect. Equity markets have been doing this. Equity markets, of course, the last couple of weeks alone is all you have to look at to know that the ups and downs are many, many magnitudes of orders of magnitude larger than changes in farmland values year to year. And so there's been an increasing, and again, this is still a small fraction. Institutional owners may only own 1% to 2% of farmland in the US, but it's a definite increasing interest in beginning to capitalize what the farmers are doing. So a farmer who needs some capital to expand may as likely in the future look to rent land from another owner as opposed to borrowing money and buying their own land. Much of the research we've done demonstrates that farmland has a positive correlation with inflation. It's good news if you own farmland and you expect inflation to be high. A low correlation with equities. Good news if you're planning your retirement and have a mixed portfolio. And a coupon that is probably above fixed incomes that are tied to treasuries. So we want to try to get through that. I know this is a tall order. If we had an 8-hour slot instead of a 1-hour slot, we would still fill it up. But we want to try to get through some of those touch points again today. Now, this is a chart I used about a month and a half ago, and I use it again on purpose, not because it's accurate, but because I want to talk about the pattern and what I think has actually happened by the end of the year here. So this is the mid-year USDA estimate percentage change year over year, and focusing on Iowa at 9.5, Illinois at 6.8, and Indiana at 7.6. You can effectively multiply this chart by 2. The total farmland values that we're seeing come back from auctions, again, corrected for or adjusted for the neighborhood effect, corrected for size and PI effects. And this is not just a superficial, anecdotal. We saw a few numbers. Very consistently, the land values are up roughly twice these numbers, including in the Pacific Northwest. Washington 5.1 could be a 15, Oregon 10.3 could be close to a 20, California could be close to a 20, except California has significant southern water issues and so on. So we'll talk through this and say, does it make sense, or is this somehow a blip? And if you've heard me before, you'll note that I never argue that I know more than markets. I always look to markets to try to understand why they make sense in the context of information. But a couple more quick slides. The next two I'll go through very quickly. If you just look at the actual nominal prices through time by region, the Pacific West, which is essentially California, and the Northeast, which is essentially New York, Vermont, and areas that don't have as intense agricultural production in row crops as we do in the Corn Belt. But the Corn Belt and Lake States and the area where we grow corn and soybeans, except for the vegetable production and highly diversified production of the Pacific West and the Northeast, which is at least somewhat driven by competition for planting houses. It's the last but most productive crop for many farmers is to plant some houses. Corn Belt has done what we might expect to have happened as the long-term arrangement for demand around the world settles out. On a relative sense, this one's just fun because you go back to 1991 and per dollar invested in 1991, this is what would have happened to your money to look through all those areas. And again, mountain states, Northern Plains, and Pac West are slightly above Corn Belt and Lake States, but you look at mountain states, there isn't much agricultural land there. And much of that increase happened early on. Northern Plains, likewise, the Dakotas have done very well valuation-wise. But again, it's a remarkable number, frankly, to have gone up by a factor of 5.5 to 6. So this is a slide I want to spend a little time on. It's a slide I update roughly every week, actually, in my own research, keep track of the interest rates, treasury rates in particular, a little bit on the CPI, but treasury rates in particular. And I went back to some old presentations I made, and I'd made a comment that the coronavirus pandemic and changes in interest rate management, trade exchange rates, food demand channels, education farm programs, and so on were happening because of the uncertainty and the interruption in the economic activity that happened right at that last vertical gray bar in 2020. at the beginning of the recession. Now, I think that I was pretty proud of myself. I got that one about right. So that circle, it landed, and the gap between rates and inflation should shrink as they both head towards zero. And look at all of the gray bar recessions. When that happens, you tend to have a drop in consumer price index. People are worried about loss of increases in productivity, tend to have a steep decline in some portion of the recession of CPI. Interest rates definitely fell in this case. And since the last two Federal Reserve chairmen, we have an accommodative policy where during recessions, we try to drive rates down to try to drive activity up. So quite proud of myself there. And then this October, I said, I've never seen such a dramatic departure between these rates. The question is simply whether Treasury rates have to come up or inflation prospects have to come down. I was completely convinced and rather, solidly patting myself on the back around that one, because there's no possible way that gap could get bigger. Well, I was wrong. The gap got even bigger, which really stresses the financial markets, and in agriculture in particular, the increase in interest in and payment from buying future ag income actually makes sense. And if you were to be honest about it, actually gives you even more room to run. So we have this tendency as humans to be technical analysts. We see a trend and then the trend changes and we think, well, it must be that we're headed back toward that trend. And in the case of farmland values, I make that particular personal heuristic decision all the time as well. But what this says is until we resolve our understanding of inflation or have an increase in interest rates, which I'll argue is not as likely as people had been arguing, there's actually room to run to buy fixed income and things like farmland. So real quickly, the share of components in the CPI. I use the blue line CPI as though it were a completely understood aggregate. And in fact, it's a pretty complicated thing. This is just showing how the Bureau of Labor Statistics uses categories and puts them together. So you take a price change by category, weight it by the amount of category for the total expenditures, even though your own expenditures might shift away from, say, housing if housing price goes up, or away from recreation if its price goes up. But 15% is food and beverage, and people will say, well, that makes no sense because the ag producers' share of food and beverage expenditures is really quite low. And in fact, it is. And I want to make that point more explicitly. It's a small share of that 15.2% expenditure on food and beverages that gets to the farm. But importantly, the proportional increase in prices on the commodity level can and recently have actually been larger than the component prices in the remainder. So in other words, it's a small share of that 15%, but price changes are more than proportionally distributed back to the small components of that. So farmers might actually do better if food and beverage goes up by 5%. Commodity prices might have had to go up by 10% for that to have registered as a 5%, for example. Again, I just think this is an interesting one and probably useful base thoughts to kind of register before looking at, what happens and how transitive is inflation expected to be. This chart, again, I update rather frequently, and I just like this one. I use some version of this a lot. But to put this in context, again, the gray bar recession is essentially the beginning of the coronavirus period or the pandemic. And energy costs, of course, went way down when we quit driving for a while. Now that nobody wants to return to public transportation in large cities, we have traffic jams, but nobody at work downtown. We have high energy costs for other reasons as well, extremely high auto costs. But the ones I want to look at are the other ones that become part of the CPI. So this helps explain why the CPI was going up. And I want to focus on the food and beverage and where it's consumed. Now, food consumed away from home, the blue line, it kind of stays solid through the entire time period. Remember, that's just the price. That's not the quantity. So food consumed away from home was relatively stable, about the same rate as the CPI in general through time. Energy, to make the point more directly, is a highly variable component of the CPI. That's why the CPI is often presented excluding food and energy. Automobiles, again, have a very profound temporary interruption, I hope, because of the loss of access to some key components of production. I told my friends I'm waiting for the rebates on the next year's model of trucks to get above $15,000 before I buy one, expecting the lots when they do come back might be rather full. But the share of food consumed at home is still dramatically higher. I don't know that we're going to get away from that. The quantity of food consumed at home is higher than it was prior to the pandemic. If we got back to a completely normal, mask-free, free-to-travel world, would that go back to its prior or not? I'm not convinced it will. The cost of food consumed at home first went up quite a bit. The scale may make this a little hard to follow because 0 to 10% is a pretty significant number. Food consumption at home went up and the price went up, but it's kind of come back down and now creeping back up. So it went up, down, back up. The share of food consumed away from home, again, not shown on the chart, the share of food has gone down and may be recovering, but not completely. I don't expect all the restaurants to come back, frankly. Cost of food away from home up, but only slightly. Housing up sharply, depending on how you measure it. That not shown. Automobiles sharply up, energy sharply up. Education costs way up. Farmland way up. Office and retail space is an interesting one. It seems like we have upgraded. Everybody can find a better space if they want, and low quality retail space may not come back. But it's not quite clear if those will come back or not to their prior number. So with all of that kind of in front of you, we'll go on to our next poll here. See if I can get my cursor to get up there. There we go. It's not going forward, Jim. What do I need to do to... There we got our poll showing. So for the next poll, given all that you've seen, do you expect inflation for the next 3 to 4 years to exceed 3% per year? Do you expect it to average 2 to 3% per year, average 1 to 2% per year, average 0 to 1, or be negative, actually experience some deflation? We'll let that go for a while. Gosh, people are voting quickly on this one. We're above 50% of you. Thank you for your response on this. And my goodness, almost 75% of you have voted now. That was a fast one. Should be able to get the display here. Can't get the display here.
You're seeing the poll.
Okay, good. So 35% of you said it would exceed 3% a year, 50% 2 to 3% a year. I happen to be in that category myself. 13% expected to be 1 to 2. My movement has been toward that category, actually. And a few think it will be 0 to 1, and a couple believe it might actually be deflationary. All of those are actually plausible scenarios. It really is truly the case that each of those are quite plausible scenarios. So I want to look now at a couple of, I would call them almost fun artifacts. How does farmland perform in periods of differential inflation? What do you expect to happen, and what might impact the amount of money we borrow in particular, and how we pay for future income in the form of rental payments or price of land? They're very, very closely tied relationships, of course. So then this is just a slide I have used before, but I really like it, and I want to point out what I expect the departure of the green and red lines to do, by Christmas time. So if you just divide up the decades, 70s, 80s, 90s, 2000, 2010, and then the long period of time, we've averaged over 6% return. That's total return, so appreciation plus current income less property taxes. Farmland has been rather remarkable over top of CPI. Now, periods like the 85 period, when we had a lender-induced farm crisis to some degree, a perfect storm as well around the world with demand embargoes and oil crisis and political unrest and so on. I would argue those are a different regime, though, because 70s and 80s had nominal interest rates well into the teens. And I think importantly, when you look at this, converting it to a spread is important to me because prior to roughly 2000, we had a different interest rate environment than I expect to return in the future. And I have a graph coming up to help make more sense of this as well. But I think you just kind of need to think about the secular decline or the secular reduction in interest rate levels that is likely to be here for quite a while, decades at least, or at least a decade. So remarkable that farmland has had most of its period of time above the level of inflation. 2009 is a little bit of a strange anomaly to me because when the housing crisis happened, that's a really fun thing if you're an economist. It's a really bad thing if you were an investor or employed by Lehman Brothers, for example. But we had the economy essentially shut down in September of that year, and everything kind of went to zero. So that spread being negative, or the green and red lines both kind of penetrating the zero line, were somewhat the housing crisis initiation. The rest of the time period, you kind of get a nice period above. I expect, just like I was wrong about the CPI and the rates, given what we've seen, and given what we've seen with rates and income in farmland, the green line and red line for 2021, when we finally hit it in another month or so and we can mark it finally, I expect those to be quite a bit wider apart. If we were to plot that today with today's numbers, the spread would almost double compared to what it had been. So the last couple of years have been very positive for agriculture. This is, I call it my obligatory slide. Always put this up to show just how incredibly massive the balance sheet, the asset side of this sector really is. On the income side and the amount of money we spend in the US, I count it as a measure of progress that we continue to reduce the amount of our disposable income we spend on food. All the while it's becoming cheaper, safer, more plentiful, more varied, and has less environmental impact in its production than at any point in time in prior history. Agriculture should be very proud of that, and consumers should be very thankful. I'll move away from my soapbox for a moment and just say it's a $2.5 trillion real estate market, 2.5 trillion, and only 14% debt, which means there's a great deal of interest in aggregating assets, adding a higher amount of debt while debt is really cheap, and thinking about, in a sense, institutionalizing the ownership of agriculture the same way that happened to what I'll call commercial real estate, kind of in the late 80s, again in the 90s, and under a couple of major legislative changes, including FIREA. If we were to look at farmland and how it's performed, the top panel here from 1990 to 2020 marks my best estimate through the third quarter. So we'll have one more quarter. The ag returns will in fact go up undoubtedly when this is finalized. The bottom ones are through the end of 2020 so that I could compare full year returns to S&P, Treasury Gold, and the CPI. If you look at the annual returns, what you notice is that farmland has been incredibly competitive. Individual equities might do a little better. A portfolio in a sector, if you're doing a tech sector, for example, might do better. But agriculture is hard to argue with as a long-term positive alpha, good returning asset. The fourth column over, the correlation in returns, I think is important to appreciate. I talk about this a lot, partly because it's a very complicated concept, but because it's also really, really important. The correlation with what I call the US Ag 32 states, if you take the top 32 states, aggregate them into one, top 32 by quantity of production or value of production, aggregate them into one, and then compare the other returns, you find out that Illinois, Indiana, and Iowa look a lot like all of agriculture. California and the Pacific Northwest, still fairly positively correlated, but makes up the difference between row crops and what I would call field crops, vegetables, productions, tree nuts, things you find in the first aisle of the grocery store. And then the plains, Kansas, Nebraska, and the dairy area, just as a proxy, Wisconsin. We do this for all the states, of course, but all of them are very high numbers, highly correlated with each other. Flipping down to the bottom, positively correlated with inflation as well. So that 0.24 is a very low number. Recently, we have had low inflation and not very variable inflation, so we haven't had much chance for agriculture to show, the correlation with something that doesn't move is always zero. But importantly, negatively correlated with the S&P over those periods of time as well. And the drawdown, or the maximum and minimum returns, shows that in equities, you can lose quite a bit quite quickly. And in agriculture, even the bad years don't turn out to be that bad. And the positive years turn out to be kind of like we've had this year, Checked on Friday, the S&P was up 22% for the year, roughly. So even the great good years in the S&P equities kind of look like farmland. So with this, why wouldn't you just buy farmland? Okay, well, because it's hard to buy. So the acquisition and disposition costs are very tough, and the holding period really matters. So for that, I'm moving on to the holding period, and you can think about, acquisition costs and disposition costs for real estate might be still 3, 4, 5%, to be blunt. The acquisition and disposition cost of equities is essentially approaching zero. We all get on our phone apps now, in our Fidelity or AG Edwards or Robinhood or something, and we can buy and sell equities in real time and not even notice our transaction costs. It's not the case with farmland. So the question really is it possible to access these rates of return? And my argument is that the further to the right you go, the longer the holding period, the more accessible these returns actually are. What's also good is the longer you move to the right, again, remembering that in history 20 years ago, we had higher rates on everything. So I would not expect those to be repeated in the current environment, because we're just, we've notched down the interest rate. We manage differently around interest rates, not just in the US, but around the world. Very targets. But I do love this chart because it just shows that on a 5-year, 10-year, 15-year basis, how stable and high farmland returns would be. The bottom three, NCREIF, annual, permanent, and total farmland. NCREIF is the National Council of Real Estate Investment Fiduciaries, and provides one of the only, again, there are issues with how you measure any data system, but they're only and best possible way of looking at institutionally owned at-scale agricultural investments. Really quite a remarkable group has come together, adopted common accounting conventions, and reported publicly the returns to intentionally managed, again, institutional, tend to be qualified plans, income on behalf of their annuitants or something. And annual cropland, recently above permanent cropland. Over the long term, you expect permanent crops, wine grapes, tree nuts, apples, to outperform row crops because of the higher risk and the participation in operating risk. But it's really quite remarkable, the level of return to NCREIF as well, which is a really good index for what you would consider institutional grade investments in farmland. Last one on my mountain of data. I just am kind of a data geek, so I like to have this in every way I can find it. This is a fun one I was doing to try to come up with an indexing system to look at when purchased, what your returns would be for institutional owners in addition to individual farmers, to just say over the last X number of years. And I just did this every 2 years, so it would fit on a single page. And I know even that makes the numbers small. But if you go clear to the right, 2020 to middle of the year 2021, go down to, say, Kansas, 10.5% for a 1-year holding period, 13.5% for a 3-year holding period, 9.5% for a 5-year, and so on. And you can look all the way back to if you bought farmland at the .com bubble, took your money out of AOL.com and put it into farm.com. You would have had, at minimum, a doubling and sometimes quadrupling of your money in that 20-year period, just on the price appreciation alone. Remember that you would have also gotten 3 to 4% annual return on top of that per year. Compounded would, add another 100 basis points almost to the totals there. I just like this chart. Okay, this is the last one before we move to a couple of slightly easier presentations and a couple more polls. But I download these data every week as well, just so I can get a sense of what is really going on in the world. If I had to have only one chart to summarize the world, this might actually be it. On the front is the date axis from 2003 to current. 11/26 is the last I could download. Along the right axis, term to maturity, 1 month, 3 months, 6 months, 1 year, all the way out to 30 years. So that's term to maturity on a log scale. And vertical axis is the constant maturity treasury yield, or the rate of return you would earn by buying treasury instruments. Why is this important? Well, these are the rates the entire world looks at. 10-year rate in particular, most heavily traded, and the 10-year rate is often reported because differences from the 10-year Treasury rate in the U.S. can be stated as, here's the Treasury plus a term premium or plus a credit risk premium. So this is a summary baseline of the interest rate environment, essentially for the world, relative to the U.S. You can look at the spread and the twists and the changes in other countries' interest rates being a result of monetary expansion or contraction. Argentina would look different, for example, and Brazil would look different, and so on, based on changes in money supply, increasing rates, or losses in productivity, decreasing rates, and so on. But in 2008, when we had the housing crisis, it lasted for 7 or 8 years, where we had a period of time where the federal government said we're going to manage production in the economy by controlling interest rates. So that blue puddle, I call it, the excess liquidity puddle, had a series of federal interventions. We called them TARP and TALF and Maiden Lane and QE1 and QE2 and 3 and 4 and 5 and 7. And we used that to try to keep the economy rolling forward while production was restarting after the housing crisis. But look at the long end of the curve. The long end of the curve was pretty high for a while. Then we got to the 11 and 12 period and discovered that it was hard for the Fed to move long rates. Got to 2016, we said, okay, the world's back to normal. Here we go again. We're going to be fine. We're going to go back to the rate hikes. We're going to get to a position where the Fed is not managing daily rates, but instead prospects for future production are really what's determining that rate environment. And of course, then the sheer cliff wall that we got again in March of 2020 is the shutdown of the economy. Looks a lot like the shutdown from September of 2008. You just get this complete drop off in short-term rates, complete chaos. We don't know if we're ever going to produce anything again. Interest rates are essentially zero. And it looks a lot like the beginning of the 2008 period. Now, I'm not a technician here. I'm not arguing they are the same. In fact, I'm going to argue they're a bit different. But we have a natural expansion of multiples we pay for income. So the point one, when interest rates are low, you'll pay more for future income. That's the same. What's different this time, my third bullet point, is that we've had massive, massive direct stimulus over top of cheap money. We don't tend to combine those effects. Historically, our fiscal and monetary experiments have not been done at the same time, at the same scale as has happened in the last 2 years. And the Fed purchases of the long-term bonds as a way to drive price up and rates down has been used as a way to manage interest rates rather than just direct intervention at the short end. And we hear you can't turn on CNN or CNBC or any of the financial news or pick up a Wall Street Journal or an Economist magazine without understanding that the debate that's raging around when to stop tapering, when to stop using bond purchases to manage interest rates has to be faced. The Fed's story has been inflation. If any of you have young kids or grandkids, or have just a fan of the, I think it's a Pixar movie, Madagascar, where the penguins say, "Wave, smile and wave, boys, smile and wave, nothing to see here." We kind of had that stance by the Fed for about a year. Smile and wave, boys, nothing to see here. We're going to be able to maintain this. There's no inflation. And then the rest of the world said, well, but there is. And so we've begun to reconcile and recognize the fact that that's happening and making some progress toward an environment where we'll have the ability to produce again. This has led to forward inflation that has had a raging debate about whether it's transitory, we're all going to go back to work and do the same thing, or we're not, or whether or not we're going to somehow enter into a new era of production. I personally expect rate hikes, but I was wrong. If you remember the slide where I made my predictions about the change between CPI and Treasury rates. The impact on real estate, however, seems fairly clear to me, especially for agriculture. If we do one of the, it's sort of like if this, then that, kind of has to happen. The physics of that are not perfect, but they're pretty strong. So here's the last of these slides that kind of give my perception about the history of interest rates and what we're setting ourselves up for. the discount rate for ag is a complicated thing to look at. And we often point at around the 10-year rate. And this is just a slice of the yield curve or the term structure at different points in time. The beginning of 2018, the beginning of 2019, the beginning of 2020, the beginning of 2021, and then last week. And this is remarkable. We have anchored the low end of the yield curve at essentially zero for transaction costs. And we've begun to rise, which signals some expectation of increased inflation, hopefully accompanied by increased productivity. That's really critical. But if you look, it's the first time in years where we've had long-term rates actually tip back down, which means people don't believe, or the folks who drive interest rates by making long-term bets with real money, including their own, don't believe the increases in productivity can keep up. Some great questions. Sorry, I've been kind of ignoring those along the way. The death of inflation is transitory narrative mean for farmland values and rents. I think that so real quickly, great question. We have had this argument that inflation is transitory. I think the question was written in a really nice way. What does the death of inflation is transitory narrative? We don't hear that out of the Fed anymore. We don't hear that out of the Wall Street Journal as much. Economist magazine points out that inflation has happened the same way in countries that didn't have the same amount of stimulus expanse. What's it mean for farmland values? It still depends on two relationships. If we just simply had inflation and return of production that supported inflation, that's very, very supportive for farmland values. The mechanism is that the increases in commodity values and trade values of things we produce is greater than the nominal increase in cost of money, and you end up with a positive impact in agricultural farmlands. Rents go up as well. That's repeated itself 80 out of 100 times in history, roughly. And so, but if we don't get back to a point where we have productivity gains and demand increases that keep up with the inflationary pressure, and that's still possible, we could discover that we've simply printed too much money. Then it doesn't translate to that effect nearly as quickly. And then it will depend more on the long-term impacts, long-term transition toward demand. With that, we'll go to a quick poll. So given what you've seen, what you know, what you've read, maybe I'm wrong, all the things you use to come up with your expectations, do you expect interest rates on farm mortgage loans in 1 year to be higher by more than 3%, increased by 2 to 3, increased by 1 to 2%? And look, for purposes of this poll, think about long-term fixed rate loans. Increase by 1 to 2, increase by 0 to 1, or decrease. Poll numbers coming in here, not quite as quickly as on the last one. 50% of you have voted. As teachers, we also sort of grade ourselves, and you always want your multiple choice answers to have about the same number of people on all the wrong answers and most of the people on the right answer. And I think on this one, I'd agree that that's what happened. The poll results are here. About 50% think will increase by 1 to 2%. I'm personally in that camp. If I had to pick differently, it would be the yellow 0 to 1. So I don't think we're going to have a massive skyrocket in 1 year's period of time. The forward rate markets are just too good. And the forward rate markets have been ignoring the Fed for the last couple of years. The dot plots, not so much, but the forward rate markets have been fairly accurate. Surprised a little bit. But I think that's a great answer. I think it's an incredibly informed answer by the participants. All right, so let's think about what does this mean for future income first. And I'm going to use a very different summary of this than sometimes is used. But I think it's a pretty good one. So farm income expectations, we could go to a bottom up and add it up. What's happening to input prices for corn and soybeans, and what's happening to demand, and what's happening to the value of the dollar, and the demand from China, and where they are on phase one, and the competition with Ukraine and Brazil. And in fact, that's important. And a couple of our previous IFAS webinars have given a great deal of information on that. They're fantastic. I'm incredibly proud of my colleagues. The quantity of stuff that's happened here in the last couple of weeks is amazing. We've pat on our own back here. Jim and Todd and others here have developed just an amazing institutional ability to deliver webinars and move things out in this fashion without traveling around the state and causing the first snowstorm of the year, which we used to do every year. In any case, if we were to just simply use the futures markets to look forward in time and say, what could we contract our prices for today for 2022 and 2023? Do we have an understanding that prices are going to head back toward any particular level? And currently the best guesses are the following. So the answer to all of those previous webinars is that it somewhat summarizes itself in price. Price is the ultimate numeraire. Corn prices projected, if I had to come up with today's projected price forecast for crop insurance next year, I would use the futures price for December 2022, which was 534 last I looked. Volatility quite a bit higher though, 25. For soybeans, 12.15 and 18. And just compare those through time and look at them. We had to go all the way back to the drought-induced prices of 2012 and 2013 to get back to those levels. That says something really, really important. Without the prospects for short production, which we had in 2012 and 2013, we are back to essentially those nominal price levels. Pretty high volatility though. Now, underneath each of these lines though, you have to remember that input expenses, especially those driven by energy, are really, really high right now. I'll try to remember to say, but if I don't, the PACE crop insurance product that was approved and is coming out for 2022 is important to pay attention to, even if you don't find an interest in it, because it's the first policy that includes the ability to have a best management practice with less fertilizer still count if you're prevented from applying it and not suffer a decline in your APH. Really critical also because it helps pave the way for farmers to have their best farming practices drive how the environmental and conservation components of crop insurance and conservation title interact without being damaged by policies with unintended consequences. Second bullet point, demand expansion for the rest of the world is definitely positive. As incomes go up, there's a very stable relationship between the diet people consume and their disposable income. And that's very positive. Export demand growth also, positive prospects, but really depends on the strength of the dollar, because in the US, we like to import TVs for $300, but if we do that, it makes it hard for other countries to buy our corn. This is just a fun little quick presentation. If you go to the website located at the bottom, you can pick commodity and time period, and we have developed a tool that will go out and invert all the option prices simultaneously and come up with a probability estimate of prices at different levels for each of those expiration dates in the futures markets. I think this is really, really cool. But again, 534 would be the break point between 50% up and 50% down, with more room to run at the top. Of course, prices don't go below zero, but they can go up quite a bit. So again, this is just today's guess. These move around based on the trade when the futures market moves up and down, reflecting information. November soybeans, likewise, 12.15, 25% chance below 10.79, 25% chance though above 13.68. So again, the ability to lock in potentially profitable production seems to be better this year than in past years. Why is that important? Because you have to pay cash rents. If you think of the income you make as a portion of cash rental payment back to your own assets, if you happen to be a full owner, these are still relevant numbers. If you can't make more farming than you could make renting, it's still reasons to continue farming. Obviously, this is not a 0-1 kind of decision, but it creates a baseline of payments back to those fixed factors of production. This is a slide from Gary Schnicke, does some fantastic work tracking rental markets along with the Illinois Society, who've been great cooperators with us to do surveys every year. Best information in the country, frankly, in my opinion. Given that I'm at Illinois, I'm required to say that. But cash rents are going up pretty quickly, and they should. And this has happened for lots of good reasons. And how does cash rent relate to the value of farmland? Well, it's the same thing. It doesn't matter if we're talking about the rent or the value. They're inextricably linked because this equation works pretty well. So there have been a lot of, and we'll move kind of quickly through the next items. We're going to run out of time, as I often do. A couple of good questions on the impact of biofuels on soybeans, a couple of good questions about historic rates, relationship to other decades. We'll get to those a little bit, but wanted to point out that I don't think markets are wrong. I think people's expectation about the required rate of return, the expected growth rate in the return, if the G gets close to the R, you can pay a lot for farmland because R minus G getting to a smaller number makes the multiple you pay for cash rent go up. So again, not to go too quickly through this, but if you were to ask that question directly with the numbers, what you would find out is that the current cap rate is around 2.95. In other words, the cash rent you could get for renting your assets is about 2.9 or just below 3%. Now, 5 years ago, I would have said 3%. That's a really low rate. It's going to be hard to compete for capital. Now, 3% relative to other assets is a really attractive return, frankly. The top slide is important to look at. The 10-year rate only departed from the implied return you can get from farmland twice in history. One in the 80s when farmland values dropped, and now when farmland values are beginning to go back up and treasury rates are below. It's a relationship you expect. The bottom chart is just to show if you handed this data set to a mathematician and didn't even tell them what was over top, it didn't tell them it was farmland or price of dog food or the cost of a car, and just said, calculate what you expect the price to be, they would have given you the skinny lines that bounced all around. I want to make 2 quick points. One, farmland markets are pretty rational. They don't bounce around as much as transitory changes in either income or interest rates suggest. Also want to point out that interest rates have been below the cap rate that farmland can earn for quite some time now. That actually does provide the pressure that we've seen in the last several months for higher transactional value. I'm going to skip through just one available in the handouts, but go on to the strength of the dollar. I've used this chart again frequently, but I update it every couple of weeks, add other currencies of value, but these are our trading partners. And so you can't just talk about the strength of the dollar in agriculture the way you can when you talk about the strength of the dollar economy-wide, where you're simply looking at some indifference among other assets you could buy in another currency against dollars because we export more agricultural products than we import. But our trading partners in the Western Hemisphere, Mexico and Canada, and Brazil, we compete with more than we trade with, but we have a different relationship with them. So you can't come up with a single number, except that China and ex-US ports, Rotterdam and else, have a reasonably important impact on the total amount of coarse grains exported. And for that, what you see is the red line, China. And again, these are number of dollars of the other currency per US dollar. So if you buy less Chinese yuan per dollar as the red line goes down, which means it's more expensive for them to buy and export. So this is, again, an illustration. You would have to weight these by our trading partners. But the arguments about the strength of the dollar, what you really want is for our exports to become cheaper if you're producing corn and soybeans and things that we do export a lot of. This, my last material slide, super messy on purpose. It's one way to sum everything up. The bottom line chart from Fred is just a single astounding number that says, how has the quantity of money in circulation? M1 is just circulation money, so it's not a great analog for the total money supply. I know that. But the M1 money supply, when we began printing money and distributing it directly through stimulus in 2020, and even the slope up after 2008, which was concerning to me, it used to be that the billions of dollars were on the horizontal 4 line. To me, I would say this is remarkable because if you did this chart in 2020, you would see that it got clear to the top of the chart and I said, oh my gosh, the sky is falling, a little chicken little on my part. But now we went through 2020 and you have to change the left-hand scale by a factor of 6. we can't even plot it anymore. So there's a lot of money in circulation, and this is M1, so it's not a great measure of total money supply, but it means there's a lot of transactional money available for purchasing things. The top, What a Drag, comes straight from The Economist magazine, says when you spend dollars from the government, it's a complicated formula, but you expect it to come back in the form of production. So if you spend it on a highway, you get a different response than if you spend it on expanded unemployment benefits, for example, or buy vaccines that don't change production but keep people alive, things like that. So the effect of stimulus on production looks especially bad. It looks terrible, in fact. This is very distinct from consumer spending. This is giving money away from the government in a form that didn't add to production, and the effects on spending, contrary to that, are distinct from production. Now that is a little bit subtle, but that second point and fourth point are important to appreciate. So look to the charts on the right, and you don't even have to be able to read them. They can be, very distinct and small on your handheld. But what it says is pre-pandemic, we're not getting back to our trend line yet. On GDP, we didn't come close. On business investment, we aren't coming close. On goods and services, add them together, we're still below, even though we're buying a lot of stuff. We're spending a lot on consumption items and creating broken supply chains. But you put them all together and you end up with a consumer price chart in the bottom right that dwarfs the amount of production we aren't undertaking. This leads to inflation or stagflation. It's going to be really tough. And I am running out of time, as I often do, so I'll go a little quickly and select the ones of these that I think are most important. But I think this transitory inflation narrative, in fact, is dead. Really appreciated the question. It was well worded. But the degree of permanent inflation is still not settled. We're going to get, automobiles back on the parking lots. We're going to get paper goods back in the grocery stores. We're going to get other things that work, but we're going to run out of our ability to continue to buy bonds. Next one, growth in household income outside the US. These two charts together are just mind-blowing. United States is really rich, and we're growing very slowly, but from high numbers. The rest of the world is growing from smaller numbers, so the percentage change can be very high. And when you grow your consumable income and are eating diets that don't have as much meat in them, you end up with a massive demand for additional meat. So in the US, again, we have very privileged debates. We argue about whether, Possible Burger or Beyond Meats taste better, or whether we can add more kale to our chicken salad or something. But the rest of the world is looking for protein. And so the global demand for commodities to feed animals is surely going up. It's not a value judgment. It's just where we are. And again, Jim has pointed out to me very politely that I'm running out of time, but we'll stay on for a few questions after. We'll get through the presentation about on time and stick around for questions for anyone who wants to stick on. So what that means is we're going to continue to demand corn, soybeans. Where are we going to supply it? From the US, Brazil, Eastern Europe, Ukraine, other parts of the world. That balance will happen. Within the US, though, water is really critical. We're going to lose some ability of production in Southern California and over top of declining aquifers, maybe add more to the Delta, maybe to the Northern Plains. Ethanol demand, this is a great question. People always ask, what's going to happen when we all drive electrical cars? And my answer is, well, we're going to blow up the grid at night when we all try to plug in our cars and double the demand for electricity. But beyond that, I don't know how fast we get there. Is biodiesel going to do to soybeans what RFS did to corn, or what ethanol did to corn? I'm not completely sure. Last one is really critical. Ag is increasingly part of the climate and carbon conversation, but we have the strange world where the private companies are competing to control the channel for making payments to farmers, because we have the Microsoft and the BlackRocks and the BPs and the Walmarts and the Royal Dutch Shell all saying we're going to be carbon neutral by a date and time in the future that's impossible for them to do without buying credits. Literally, you can't reduce the amount of electricity you use as Amazon by changing your light bulbs in your AWS centers. So the connection between government channels for pricing carbon in ag and private markets for pricing ag, where the cost across will really have to be settled here. And that one's going to be a really big deal. Rental markets are really slow moving. So I don't expect rents to move as quickly as changes in income. They're just long-term and sticky. We know that. And I also expect that consumer preferences and preferences for sustainability goals beyond an individual will continue to pop their head. My last slide, we've been moving toward crop insurance changes, and the last few years have been remarkable. They're getting really different, very positive, overlapping programs between crop insurance and conservation I expect to continue, and look for changes in federal policy to at least be expressed partly through crop insurance. I'm going to skip through the financialization, except to say, if you were to look at, I go to the expo, the Farmland Expo in Des Moines every year in January. It's a really fun, if you haven't seen it, People's Company supports it, the expo, a very large collection. And this year, Sam Zell is the keynote. And that's remarkable to me because Sam is one of the absolute icons in real estate investing through time. And when you have one of the most successful long-term real estate investors ever presenting at a farmland conference, I think you've turned the corner to some degree. So last slide, for those of you still on, thank you again. I apologize for being late here. Do you expect farmland values in 5 years to be more than 25% higher? In other words, 5% a year sustained, 10 to 25, which is by the math, 2 to 5% per year, 0 to 10, with 0 to 2 per year, or decline in the next 5 years, decline at all in the next 5 years, or decline by more than 5% in the next 5 years. And again, that's relative to the value that you believe exists today.
And we'll let them go ahead and fill that poll out while we wrap up here very quickly. I do want to remind folks that there is one more webinar that's coming up on Friday. That one is on farm policy. We'll include Nick Paulson, Krista Swanson, and Jonathan Koppas. And we also want to thank our sponsors, including TIA's Center for Farmland Research. You've been listening, of course, to the Director of Farmland Research. He'll come back to us in just a moment. Bruce Sherrick. Compeer Financial helps out, as well as Corteva Agrisciences, Farm Credit Illinois, Illinois Corn Growers, the Illinois Soybean Association, FS Growmark, the University of Illinois Extension, and the Department of Agricultural and Consumer Economics. We also want to thank Jim Baltz, who's behind the scenes. Were the numbers that you saw in that quick poll about what you expected to see, Bruce?
They are, in fact, 10 to 25% higher. The modal answer was 0 to 10. So most people think, 80%, 90% think it'll go higher, 10% think it'll decline, and those don't think it'll decline by much. I'm in the same camp. I completely agree, in fact, on this one. And again, one of the things I always like to end with is, what asset would you rather own? I think that's an important one to think about. If you have any portfolio room, how to get access to it is still complicated. A couple of questions. Again, thank you all for participating. Thank you for sticking around. I apologize. I'm kind of long-winded on these things. I care a lot about it, and so get a little too excited perhaps about it, but have really enjoyed the last few years in particular, looking through this asset class and interacting with everybody. We've had great participation by everyone from individuals to the farmland funds to the Illinois Society and other state level to input producers to the capital providers. The lenders have done a great job, I think, in the last few years of upping their quality of information systems. And the groups following farmland, like Leading Harvest, happen to be on their board, a group trying to just simply improve the ability to know things about farmland going forward. So it's been a period of time where the professionalization, if you will, of the asset class has been really remarkable. And of all the things that could have broken during the pandemic, the number of things that did go bad, some, processing plants and other things, I think agriculture proved itself to be incredibly resilient and feel very fortunate to have had a career in the most important industry in the world. A couple of quick questions on the end. Are we headed to a yield curve similar to Japan? Oh, that's a great question. There's a bit of a long preamble there that for whoever typed that, I'll agree with. We have had a couple of epochs, EPOCH, not epic periods, but epochs of time, where we've had long periods of Fed intervention. Now in the US, we have a different degree of independence between our Fed than many countries, including Japan or China. But are we headed to a yield curve similar to Japan? I don't believe so. I don't think the world can actually accept negative rates the same way economies can create a cash drain or a cash store by having short-term rates be negative. And again, remember, it's short-term lending to the government rates that get negative, not actual rates. Inflation being higher than nominal interest rates has a similar effect, of course. But I just want, for those of you in my age cohort, imagine teaching time value of money to students who've never experienced positive interest rates. I don't expect that we'll get anywhere close to Japan in that regard. Long-term price of soybeans due to green aviation and diesel fuels, great question. On top of that, we have a whole bunch of other capture technologies coming out. I spent a couple of days last week with a remarkable company. Equilibrium Capital has invested in methane capture in some of the largest dairies in the world and have, really faced head-on what to do about concerns about the impact or relationship between food production and the environment. And I think that in the large is amazing to contemplate because, again, a few kudos to Equilibrium. Their tagline is using markets to transform the world towards sustainability. I may have mangled the mission statement or the tagline a little bit, but it recognizes you have to use market forces if you want to move toward more sustainable production. In the capitalization formula, how do you handle a negative R minus G where the growth rate exceeds the required rate of return? What you do is you hope you're an owner of that asset and you laugh all the way to the bank. What happens, it's a great question. It's clearly an academic question. I don't mean to make light of it. If the growth rate exceeds the required rate of return, then by the math formula, it looks like you go through something that's infinite. It doesn't happen, of course, in the real world, but what that leads to is really high rates of appreciation. Again, it looks like we're shutting down. I appreciate all of those who've stuck around. Welcome to hop off. Apologize for keeping you for more, but appreciate your participation today and hope you can join our future upcoming webinars. And join us on the web as well, our FarmDoc and FarmDoc Daily websites. Have a great enterprise here for trying to respond to and provide useful information to producers and those in the ag sector.
Indeed. And thanks, of course, to Jim Baltz, who's been behind the scenes and making things work properly. This, of course, will be archived up on the website. You can find this at farmdocdaily.illinois.edu in the webinars section. You can also go to YouTube down there at the bottom, youtube.com/farmdoc video. And Bruce, I'm really looking forward to seeing you actually at the iHotel on Thursday, along with former U.S. representative from Minnesota and one of the primary architects behind farm bills for the last several times, Colin Peterson. Should be a good program that day. You're going to be talking about carbon markets for them, and I'm really interested to hear what you have to say. Again, on behalf of Jim Baltz and Bruce Sherrick, I'm farm broadcaster from the University of Illinois, Todd Gleason. You have a good day, and thank you for joining us here at the Illinois Farm Economic Summit.